I believe that it's very easy to predict that there are going to be lots of successful companies born of the internet.
The 60 million in the first 6 months, which is a pretty insane way of going about things, but we were just caught up in this mania. And mid
660s or 670s, and we talked about it then. I mean, there's.
If you look at the course of history, you will see that it is chock full of trends that seemed like good ideas at the time, but did not really pan out to be as pretty as people had hoped they would. The dot-com bubble is one of those trends. Now, bubbles are typically associated with all things bright and shiny, but in this case, it's not. Today, I'm going to be talking to you about the dot-com bubble, or the period of time of a few decades ago that investors began pouring money into internet-based companies. It was also known as the internet bubble. Unfortunately, while bubbles are magical and fun when they are blown, they are fleeting. Bubbles burst. So sit back and relax as I tell you all about the dot-com bubble, what started it, how it crashed down, and what happened after the fallout. This is Business Explained. To learn more about all things money, get educated about how to do business, become business savvy, and enjoy more videos like these, subscribe to my channel and click on the notification bell, and may you be granted with many, many sweet returns. So basically, the dot-com bubble refers to the really fast rise of the stock equity valuations for the United States tech market. The innovation of the internet led to so many technological breakthroughs, and when the dot-com wave rolled in during the late 1990s, individuals and companies alike wanted to ride the wave and venture into the technology market. The value of the equity market went way up and grew within that time period. The NASDAQ index went up from just below 1,000 to over 5,000. However, from 2001 to 2002, the bubble burst. From a high of 5,048.62, the NASDAQ index plummeted to 1,139.90. This drop was triggered by the crash of the tech market, and it was a whopping 76.81% fall. The implications were massive. Investors lost trillions of dollars when the bubble burst. According to experts and analysts all over the globe, it was simply too good to last. Picture a star that burns too bright, too fast, and eventually just burns out completely. The dot-com bubble was just like that. However, the thing about fad-based investments is that they are incredibly difficult to pinpoint until they crash. That is why so many people get swayed into investing in the first place. It just looks so promising from the get-go. But wait, let's backtrack things a little bit. Let's take a look at the history of the internet bubble to understand it a little better. So, as we all know, the internet is an incredibly diverse platform to do virtually anything digitally. Nowadays, we can buy and sell things on e-commerce platforms, dig up information on basically anything you want to find out about, and so much more. Investors in the late 90s saw the potential of the internet to be a multidimensional platform. That was why they invested so much into the internet-based companies. This was because the domain names only came into use around the late 1980s, and during those times, there were not a lot of people who were skilled at using them. By the end of 1985, there were only a total of 6 domain names in use globally. However, over the past few decades, that number grew to a whopping 265 million domain names. A domain name zeroes in your website's location on the World Wide Web. It makes it easier for people to locate you and know what you're all about. That's why it was so attractive. People wanted to get their businesses on the internet and get as much reach as possible. On March 15, 1985, the first registered .com domain in the world came into the picture. It was a domain for Symbolics Inc., a computer manufacturing company located in Massachusetts. It kept the domain name for about 25 years before selling it 25 years later. It cemented its place in history as a first appropriately registered domain name, and it did pretty well. Now, before 1995, domain name registration was free. That meant that anyone who wanted their very own web address could just register it free of charge and enjoy whatever benefits that allowed. However, the National Science Foundation awarded Network Solutions, a tech consulting company, rights to charge people for registering their web domain names. From that point forward, domain prices began at $100 for a 2-year-long registration period. Now, these domain names were the addresses and facades of the online companies. They were the business trend of the decade, with a new online company sprouting up almost every day. These online companies meant that each of them had an individual web domain name, and that there were investment deals coming in that were worth millions of dollars, and stock offerings that were worth a whole lot of money. For a time, the possibilities seemed endless as the world ushered in a new era of internet-based businesses. Want an idea of how much companies were investing into the dot-com bubble? Well, on January 30th, 2000, 14 dot-com companies paid over $2 million each to advertise during the Super Bowl, which made people call the game the dot-com Super Bowl. Imagine pouring that much money to advertise your company. Now, it probably still sounds all well and good up to this point, but remember, as I told you earlier, bubbles burst, and this whole venture is just too good to last. The exorbitant amounts of money and the attractive deals masked one very big problem. Nobody in the dot-com business really knew what they were doing. Neither investors nor the boards or heads of the dot-com companies actually knew what they needed to do to make sure their companies lasted for a long time. So why did the dot-com bubble finally burst? Well, analysts point to two reasons. The first is how the companies did not pay much attention to how much money actually came into the companies. They did not know how they were able to generate revenue. One theory points to the bubble bursting due to too much focus on the network theory. The network theory alludes to how more value is built up the more the network is strengthened. While theoretically it could work, it did not explicitly state how companies could use networks to create income. They simply did not focus on the one thing that would ensure the company's longevity: profit. Because of this, they were spending way too much money and not really getting that much back. Secondly, analysts say that the stocks that arose during the dot-com bubble were significantly overvalued. It was mostly just hype without any real data backing just how profitable or valuable the stocks were. So yes, like I said earlier, it was very fad-based investing. When the bubble burst, a lot of companies were forced to close down, and a lot of investors faced very steep losses. However, there were a few companies that survived the bubble bursting. You've probably heard of them: Amazon, Priceline, and eBay. In fact, they're still pretty prominent internet platforms today. Considering that the dot-com bubble wiped out investors of trillions of dollars worth of assets, it is safe to say that nobody would want to risk investing into such a venture. So, with technology and the internet being incredibly prominent nowadays, how do we avoid from entering yet another bubble? Here are a few things that investors and companies should remember. Firstly, just because something is popular, it doesn't necessarily mean that it has value. The dot-com companies looked incredibly promising, and a lot of people were getting into them, even if they were not a profitable venture. It is always better to invest in a company that is deeply rooted on the fundamentals of business rather than companies that are shiny and flashy. Buzz can only take you so far. Typically, popular companies that do not follow a solid business model are only good for short-term gains, but it will not take you where you want to go if you're looking for something long-term. Secondly, it wouldn't do to just rely on how much something might be worth in the future. In other words, speculation won't do much for you. Sometimes, valuations on certain companies can be a tad bit too optimistic, and they base their future profit off what could happen instead of what is actually happening. You can't value a company at $100 billion when it only makes a little over $1 billion per year. Thirdly, companies must always be founded on sound business models. Companies must know how to generate revenue. They must have a solid, concrete plan on how to earn back the money that they spend and build their bank. A successful company is way more than just a bright idea. It has to have all the intricacies of running a business ironed out in order to be truly successful. Again, popularity is not that good of an indicator. MySpace was an incredibly popular social networking site in the early 2000s, but it ended up losing over $1 billion between 2004 and 2010. So what are your thoughts on the dot-com bubble? Do you think you would have ridden the wave and established your own internet company as well? Do you think there will be yet another bubble, but this time in the tech sector? Let me know what you think, and let's talk about it in the comment section down below. I'll respond to all of you who comment within the first hour. If you enjoyed this video, you should definitely check out my next video on the Solar Energy Bubble EX to learn about yet another bubble, but this time in the field of solar energy. For years now, people have been trying to make the switch to using the sun as a source of energy. However, experts and analysts are claiming that we're in a sustainability bubble and that we are over-investing in solar energy. Watch the Solar Energy Bubble EX to learn more about what I'm talking about and see whether or not solar energy really is worth investing in. Stay tuned, stay educated.